Hello. Hi everyone. Thank you so much for connecting today. And so the agenda for today is to understand about the mandatory compliances which will be applicable for a private limited company. So before we start off, we'll just wait for a couple of few minutes here so that everybody else joins in. Alrighty, let's get started. So when I'm talking about the mandatory compliances for a company, before moving on to the mandatory compliances, the first thing that we'll have to know is your company even actually registered? How do I know that your company is actually registered? What are the documents that you have? And is this company a legal entity? And is this recognized by the government of India? For these purposes, there are few things which is mandatory. The first thing, the reason as to how you will get to know that your company is registered is to have certain documents. And when I'm talking about certain documents, it includes documents like your certificate of incorporations, memorandum of association, articles of association, your PAN, TAN, GST number, and ESIC number. So there are a few ways. If you've already not received some of these documents, then you can reach out to our team, and a team can help you extract the documents like your certificate of incorporation, MOA, AOA, and other details. Or if you're still looking to start off your new company after this session, so that you have a clear idea as to what the compliances would be, and post which, if you decided to incorporate your company, you can reach out to a team, and a team would be more than happy to help you out with that. So before further, so we'll go ahead and start I'll provide a brief introduction about the various compliances which are applicable in case of a private limited company. So let's get started. There are various statutes which are applicable. One of the main statutes which is applicable is the Companies Act 2013. Then comes, and the Companies Act contains a lot of sections, and in order to talk about few of the sections, as soon as the company is incorporated, you will have to ensure that you need to appoint an auditor, share certificate has to be issued, and let's say the board resolution, couple of other things has to be ensured with. Post which, that one of the main thing in order to which a lot of people are concerned about is the income tax. And post that, the GST, the FEMA, which is also commonly called as Foreign Exchange Management Act, and this is generally applicable in case of cross-border transactions which will be involved, and in case where there's a foreign director or a foreign shareholder who is coming into India, then RBI guidelines also has to be followed, which also includes the master directions. And if let's say you have couple of employees in the organization, then various other labor laws would be applicable, like your professional tax, provident fund, ESIC. And subsequently, if you're planning to take your company into an IPO, then it is mandatory that you will have to comply with the SEBI guidelines. And then if you were falling under various certain sectors like insurance, then IRDAI guidelines was required. If you're under fintech, then RBI guidelines is required. Or if under real estate, then RERA compliance is also mandatory. Now let's deep dive into each of the compliances which would be applicable for these companies, these statutes which would be applicable. Now let's say with respect to the Companies Act and as soon as the company has been incorporated. So one of the main thing which is required is to ensure that the shareholders who have subscribed to the shares of the company will have to transfer the capital amount into the bank account of the company. And for this purpose, it is mandatory to have a bank account. You can open a bank account in any of the banks. It is not mandatory that it has to be a scheduled bank or any other bank. You just have to open a bank account, and the shareholders of the company should transfer the share capital based upon their requisite shares subscribed, and it should be transferred to the bank account of the company. Now, assuming that the investors have already transferred the share capital, the requisite share capital to the bank account of the company, it is imperative on the company that they will have to intimate to the government now. The sole reason is that at the time of incorporation in the MOA, there are certain clauses which state that the shareholders of the company will be specified and the number of shares which they have subscribed will also be specified. In order to intimate to the government stating that the shareholders have actually paid the amount, we will have to intimate. So for this purpose, the company is required to file a form called a Certificate of Commencement of Business to the government, and this has to be done within a period of 180 days from the date of incorporation. If the Certificate of Commencement of Business is not filed, then a penalty of around 1.5 lakh rupees can be levied upon. So it is essential that the Certificate of Commencement of Business is filed as soon as possible so that you can carry out your transactions. And point to be noted here is that if the Certificate of Commencement of Business has not been filed, you cannot transact any other transactions like your purchase, sales, nothing. None of these transactions can be done until and unless the Certificate of Commencement of Business has been filed. Though the word itself states that this is a Certificate of Commencement of Business, but in fact, we do not receive any certificate as such from the government stating that, okay, you can now commence your business. It is just a declaration which is provided and by the company stating that all the shareholders have paid the necessary share capital, and the company acknowledges the receipt of the capital, and post which the company can now start its operations. On the contrary side, let's say there is a foreign shareholder who wants to invest in India. So now the organization should also consider with respect to RBI guidelines as well as the FDI rules. When I'm talking about FDI, so basically means foreign direct investment, and it also depends upon which sector the company is being incorporated under. If let's say under real estate, then the FEMA guidelines does not allow a foreign national to invest into the land in India. The simple reason being here is that the Indian government does not want to sell the land to the foreigners. So as such, the RBI guidelines have clearly stated that no foreigner can invest into a real estate company. Or let's say some other sectoral approvals like your education industry. So in case of an education industry, the FDI limit is 100%. When I'm talking about this 100%, what exactly does this mean? It means that the foreigner can invest up to 100% of the capital of the company. Or there might be an industry, let's say defense. So the the FDI limit, let's say assuming it is around 30%. So this means that out of the total capital of the company, the foreign shareholder can invest only 30% of the paid up capital, and this limit cannot exceed the threshold at any point in time. Assuming that the company has been incorporated and the foreign shareholder has deposited this money. But since it involves cross-border transactions, it is mandatory that the shareholder, the banker, will be required to do the KYC of the foreign shareholder. And for this purpose, the banker will ask the reasons as to why the funds have been transferred by a foreign national, what is the purpose of the funds, and how it is going to be utilized. Post the KYC, once the funds have been deposited into the bank account of the company, The company, the Indian resident director, who is a part of the company, will be required to intimate to RBI. So for this purpose, the Indian resident director will have to file certain declarations to the RBI, and one of the first one is to creating a profile in the RBI's portal, and post the registration is complete, we need to file certain forms called as Form FCGPR, and this has to be done within a period of 60 days, and post the funds have been deposited, the share certificate has to be issued. Now moving on to audit. So in case of audit, there are various statutes which are applicable, like initially discussed, the Companies Act, Income Tax, GST, FEMA, RERA, various acts would be applicable. And one of the most prominent acts which would be applicable is the Companies Act. And is audit mandatory for a private limited company? That is one of the main questions which has to be addressed. So when I'm talking about the audit, at least in case of a private limited company or a sole proprietor private limited or a one-person company, audit of such companies is mandatory. The audit does not depend upon any turnover or paid up capital or any other factors. It is mandatory irrespective of all the factors which has been stated, and hence it is the company should appoint a qualified practicing chartered accountant for the purpose of audit of the company. Now, there might be various kinds of audit which have been required under various statutes, and when I'm talking about the mandatory audit, it is as per the Companies Act. Now, who will appoint these auditors? So, initially, the auditor will be appointed by the Board of Directors, post which it would then be confirmed by the shareholders in the EGM. And what would be the tenure of the first auditor? So the tenure of the first auditor would be at least for a period of 1 year, and post that the company can appoint the auditor for a maximum period of 5 years in case of an individual auditor, and if it is a firm of auditor, they can appoint them for a period of maximum of 10 years. The role of the auditor would commence only at the end of the financial year, but however, the auditor should be appointed within 30 days of incorporation of the company. Now, talking about the Income Tax Act. Income Tax Act clearly states that it does not want to harass the small companies whose revenue is less than 1 crore. So the Income Tax Act states that only and only if the turnover of the company is more than 1 crore, then tax audit, which is income tax audit, as per the Income Tax Act, would be levied. And under this Income Tax Act, the auditor will verify various clauses. There are around 44 clauses which the auditor will verify under the Income Tax Act, which amongst other things includes verifying whether the depreciation as per the income tax has been computed properly, the TDS has been actually deducted as per the respective slab rates, and whether any cash transactions has been done, and whether in case of manufacturing industries, the certain guidelines have been followed with the valuation of inventory, and as per in case of inventories, again the valuation of inventory will also be considered. Now, coming with respect to GST, again in case of GST, there are certain other audits which is required, which would be done at the end of the year, and likewise to Income Tax Act, it is not mandatory for all the companies, but only for those companies whose annual revenue is more than 2 crore, GST audit will be applicable. So under GST audit, again it will be done by a practicing chartered accountant, and the auditor will verify here whether the purchase and sales details as per the GST returns are matching to the financial statements. And generally the due date for all these audits, let's say for the Companies Act, is 30th September, income tax is 31st of October, GST is 31st of December. Moving on to some of the compliances which should be applicable in case of Companies Act. Like we initially discussed, the appointment of auditor. As initially stated, the appointment of auditor will be done by the board of directors. So how does this happen? The board of directors will first convene a meeting, and for this purpose, in order to convene a meeting, a notice of the board meeting will be provided to all the directors of the company. And once the notice has been provided, the board of directors will arrive at a specific place, and then whatever is the resolution which is to be passed, they will pass such resolutions. Like, let's say, appointment of an auditor. So in the notice of the board meeting, it would be stated that the company proposes to appoint XYZ as an auditor. And subsequently, when the board of directors arrive at the board meeting and subsequently pass the board resolution, this has to be documented. All the decisions which has been taken by the board of directors should be documented in a form, and those records are called as minutes of the meeting. The minutes of the meeting shall be kept for a very long period, let's say around 7 to 8 years. It should be mandatorily kept by the company. And any decision, be that even for the smallest of the smallest decision, should be taken care by the board of directors. Just to give you a brief example as to why the board of directors play a crucial role in the organization, let's take an example of Reliance. There are crores of shareholders who hold the shares of Reliance, but the ultimate decision maker are the board of directors. Let's say you are holding few shares of Reliance company, and you cannot tell the board of directors that this is how you need to operate the organization, what is best for the organization. No. The common shareholders do not have any right to guide the board of directors as to how to operate the company or interfere in the affairs of the organization. It is only the board of directors who have the ultimate responsibility for the purpose of carrying on any operations related to the organization. The board of directors or the director can hold shares in the company, or he may be a person who does not hold shares at all. Now, talking about the share certificate, when the company is incorporated, it is necessary to have a certificate stating that the concerned person holds the requisite number of shares, which at the time of incorporation was specified in the MOA. And for this purpose, it is necessary that the company will issue a share certificate specifying the name of the investor, the shares which have been held, the paid up capital, and this certificate will then be signed by at least 2 directors. The share certificate should be issued within a period of 160 days from the date of incorporation. But how does this make it as a valid certificate? For this purpose, it is necessary that the share certificate should be printed on a stamp paper and then subsequently be notarized. Once these share certificate have been issued, the board auditor has been appointed, and the certificate of commencement of business has been done. At the year end, there are certain additional compliances which has to be done by the company. Talking about the directors, there are various requirements in order to become a director, and under section 164, it specifies as to what are the disqualifications, and few of them. Let's say, if a director of a company has failed to file the financial statement for a continuous period of 3 years, then the director shall be disqualified. The director shall not be guilty. He does not have any offense under any of these acts. He is not imprisoned. There are various around 20 clauses which have been specified, and for those clauses, every year the director will have to provide a declaration stating that so and so director is not disqualified under these sections, and this declaration has to be provided by each director at the end of the year. This would be provided in the form called as DIR 8. Post this, there might be a couple of directors who have interest in some other company as well. Now let's say, taking an example of Mukesh Ambani. he is a director of various companies, Reliance Limited, Reliance Jio, Reliance Infocom, various other companies. So at the year end, the director should provide a declaration stating that he has certain interest in other companies, and this has to be provided every year at the end of the year or as and when the interest arrives. So taking an example, let's say Mr. Mukesh Ambani invested in Jio on 30th June, and the board meeting which was to be convened was on 1st of July. So in the 1st of July, Mukesh Ambani should intimate to the board of directors stating that he has an interest in Reliance Jio. He cannot wait until 31st of March of subsequent year and then declare this interest. The sole reason here is to avoid the related party transactions between the companies and ensure that the transactions between them are taken care in a free and unbiased manner. The next one is the DIR3E KYC. So every year, the directors will have to adhere to the KYC norms. It is a very simple compliance which has to be done, which quite often a lot of directors do not adhere to, and consequent to which a penalty of rupees 5,000 is levied. It is a simple declarations and which has to be done, which requires you to ensure that your address, your PAN card, your photograph, your email ID and certain other basic declarations, basic details of the directors are correct, and this has to be done on every yearly basis. The due date for these declarations for the DIR3 KYC is 30th of September. Now let's say the financial year has ended. It becomes necessary then to ascertain what is the exact financial position of the company. And for this purpose, it is necessary to prepare the financial statements. And financial statements cannot be prepared in any format. There are certain specific schedules which has to be followed. And for the companies registered in India under the Companies Act, the Companies Act has specified the Schedule 3 which is applicable, and for that purpose, it is mandatory to ensure that the financial statements are prepared in accordance with the generally accepted accounting principles. The Institute of Chartered Accountants of India has also provided certain accounting standards which are applicable. Like, let's say, depreciation. The depreciation, if you have purchased a laptop, you just cannot claim the entire expense in 1 year. The accounting standard states that you will have to claim the expense which is in the form of depreciation of around only 40% a year. Assuming that you own a car which is used, let's say Ola. They own a couple of cars which is owned by them, and for that purpose, certain rate of depreciation is again specified. The entire cost of the car cannot be claimed as a depreciation in the first year only. It is spread across the useful life of the asset, and which is specified in the company in the Income Tax Act. Now moving on to assuming that the financial statements of the companies have been prepared. The next thing is to provide these financial statements to the auditor. Now, one of the most important things is that how does the general public know that the numbers which have been specified in the financial statements are accurate? In order to do so, it has to be verified by a third party, and generally this is being done in the form of an audit of the financial statements. And this audit is as per the Companies Act. Like we earlier discussed, it includes various audits, but mandatorily by default for all the companies registered under the Companies Act, it is necessary for the audit. The auditor will ensure that the financial statements have been prepared accordance to the generally accepted accounting principles. They have followed all the guidelines and statutes which are applicable to the company, and the numbers which have been specified in the financial statements, like let's say your revenue, your expenses, the profit and loss, and the tax liabilities, and the numbers which have also been specified in the balance sheet, like your property, plant and equipment, the equity, the liabilities, all those will be specified. The auditor will check again all the numbers with respect to the proof which is applicable. After considering various checks and protocols which have been specified under standards of auditing, the auditor will check all those numbers and ensure that the financial statements as well as the company is adhering to the various statutes applicable to them. Now let's say the financial statements have been prepared and it has been subsequently audited. Now, it is also necessary that the directors of the company should provide a report to the shareholders. Taking back to the example which I had initially discussed for the purpose of Reliance. So Reliance has certain number of directors, assuming that they have 10 directors, and there are crores of shareholders. So the person who best knows as to what is happening inside the company are the directors. So that the directors at the year end will have to provide a report to the shareholders stating that how did the operations of the company were coming in, what went wrong, what went right, and what the company intends to do in the future. What are the projects in the pipeline, and if there are any losses, how is the company taking active actions in order to mitigate those losses or reduce the losses. Also, sometimes there might be a possibility of reporting of a CARO reporting, which is called as Company Auditor Report Order. And under this, there are certain declarations which has to be provided, like your inventory, your inventory of the company is as per the Companies Act, the valuation is correct, the fixed assets are as per the various statutes, the valuations, and all those details are necessary. But however, is this applicable to all the companies? No. I would not state that the CARO reporting is applicable to various companies, but however, CARO is applicable only if your turnover crosses more than 10 crores, or your capital is more than 1 crore, or the borrowings from the public is more than 1 crore. Only in those circumstances, it becomes mandatory that reporting under CARO is mandatory. If you all have any questions, feel free to drop a comment and we will take those queries at the end of the session. Moving on to the next, one of the main documents, there are a couple of documents which are required to be maintained by the company. And few of these documents there are at least 7 documents or the registers which the company has to maintain. One of the first one is the register of members. So under these register of members, these are none other than the shareholders of the company. When I'm talking about the shareholders, there can be again 2 categories. The first one is the members holding the equity shares. The second category is the members holding preference shares. So the company has to maintain a complete list of the shareholders, and this register will contain various details like the name of the shareholder, the folio number, which is basically the share certificate number, how many shares the person holds, and other details. Now subsequently, and please note, the register of members, generally there is a portal on MCA wherein few basic details of the company and other details can be viewed. But the details of the members are not made public. No person can just log into MCA portal and verify as to who are the shareholders of the company. But however, if you're a shareholder of the company, you can make an application to the company and the company will provide the list of the same. Talking about the register of directors and the KMP, which is called as the key managerial person. Register of directors. So this register is also available on the MCA database portal, and any changes which happens should be considered here. But on the contrary side, in case of MCA database, only the current directors of the company are specified. Now, talking about KMP, which is also called as key managerial person. Who is a key managerial person? Who are they? So the law specifically states as to who is a key managerial person. It can be a person other than the director as well. So let's say the chairman of the company, the chairperson, few of their relatives, or the people who are taking key decisions of the company. Even though they do not hold a single share or they are not a director of the company, they can be considered as a key managerial person. Now, another kind of register is called as register of charge. So in case of charge, there might be quite a possibility that the company takes a loan. And in case of a loan, one of the most common requirement of the banks or the financial institutions is the requirement of a collateral. And it is necessary that this collateral is registered. And once the collateral is registered, a certain form has to be filed to the ROC, which is Registrar of Companies, and this list will also be made public in the MCA database. So any person who wants to verify the charges which have been registered of a particular company, they can simply log into MCA portal and check the company master database, and the list of charges which have been registered by the company will be reflected there. And once this another kind of registration certificate is called as the share certificate. Quite often, and generally most of the times right now, we are living in the situation of a digital economy, wherein digital era, wherein all the transactions are happening digitally. But however, all the transactions generally, if you would have considered the stock market, if you invest in, let's say, in one share of Reliance, the management of Reliance will not provide you a share certificate manually. But however, this share certificate is reflected in your demat account, which is maintained by the CDSL or NSDL. So these documents, but however, in case of an unlisted company, like the general companies, let's say Swiggy, all other companies, their companies are not listed on the stock exchange, or they are not public, or if they have not maintained their records on a dematerialized format. For those reasons, it is necessary that the share certificate should be issued physically, and these share certificate will then subsequently be notarized and then stamped. It should be printed on a stamp paper, and you may ask, what is the value of the stamp paper which I should consider for the purpose of share certificate? Generally, it is 0.015% of the value which is being specified, and post which it has to be notarized. So generally a lawyer will be the person who has been authorized for the purpose of notarization. Let's say the share certificate for a private limited has been issued, post which the company will be required to ensure that all the details, if the main person who has to issue the share certificate is the company. So the company should keep a track of all the share certificate which has to be issued, and this provides an evidence that the person holds certain shares in the company. And since these certificates are in the physical format, there can be quite a possibility that these certificates can be lost. So for these reasons, the shareholder can make an application along with an FIR filed in the police station, and various other documents needs to be provided to the board of directors, and then subsequently the company will provide a duplicate share certificate. Now, talking about the employee stock option, it has become quite common nowadays for various organizations or the startups to provide an option to the company, option to the employees of certain stocks. And when I'm talking about stock, it does not mean an inventory. So what I'm meaning, the term stock here refers to the equity share or the stakes in the company. And this can be backed by various conditions. To explain in a simple condition, let's say a new startup, assuming Swiggy. So when it initially started, they would have only few investors and the board of directors and a very small team. But subsequently, in order to maintain or ensure that the team or the technical team who has initially supported the company would provide them a condition stating that if you stay back for 3 years, let's say, the company will provide you certain equity shares of the company. of so and so value, and for that purpose it is mandatory to fulfill certain conditions, which is called as the vesting conditions. So post that, once in the instance situation, the condition which was provided by Swiggy was that the employees will have to stay back for a period of 3 years, and post that the equity shares will be provided. So there might be a number of people to whom the company wants to provide the stock options. It can be various conditions for different category of employees, and for this purpose the company has to clearly register as to what is the conditions which has been provided and how many shares will be provided upon the conditions being fulfilled, and what are the value of each share once the equity share is allocated to the employee. Now also there is the last and the foremost register which is required is the securities bought back. Assuming that Swiggy gave a couple of equity, they had sold their entire stakes to various investors. Now that Swiggy is doing well, the investors want to sell their securities to some other investor, but the management of the Swiggy, let's say the board of directors or the investors or the earlier founders, they want to purchase back those securities which they had initially sold. So what the company would do, the company would pay back to the investors stating that I will repurchase the securities. So initially the company had sold to, let's say, an investor A, and then now the investor Mr. A wants to sell it to Mr. Person B. But however, since the company has sufficient funds and they are surplus reserves, the company wants to buy it back. The company is stating that I do not want you to give it to some third person. The company would want to purchase it by themselves. So for this reason, in the register of securities bought back, the company will specify as to what rate it had been purchased, from whom it had been purchased, if there was any conditions, and all of the details will have to be specified in these details. One of the most important and quite commonly asked questions is with respect to the tax planning. What is the tax rate which is applicable, and a couple of other details with respect to Income Tax Act. Generally, people assume that the tax rate in case of a company is 30%. Yes, they are partially right. But however, in order to consider those details, 30% is applicable only for those companies where the turnover of the company is 400 crores or above. And for all other companies, the tax rate which is applicable is only around 25%. But you would have also considered there are certain additional levies which are applicable, like your surcharge, your education cess. So there are certain additional levies which are charged by the income tax. And assuming that in case the general tax rate is around 25%, post this, if let's say the revenue of the organization is the profit of the organization is more than 5 crores. So for that purpose, 1 crore, then around 7% as surcharge will be applicable. And on top of this, irrespective of whatever is the turnover or revenue, a levy called as education cess is levied at the rate of 4%. So roughly, if I would say, in case of the general tax rate for a company, it would be around 27 to 28%. That would be around the general tax rate which is applicable. And these tax rates are not based upon the slab rates as commonly confused with the income tax applicable for salaried individuals. In case of a company, irrespective of whatever is the income or the profits or expenses, a flat rate of 25% is levied upon. No questions asked, a flat rate is levied. Even on a single rupee, tax rate would be levied. Recently, the finance minister had introduced certain sections It's called as 115BAA, 115BAB, new sections for the purpose of reducing the tax liabilities of various people. And one of the most common thing is 115BAA. So in case of 115BAA, the general tax rate was around 25%. But however, the government stated that the tax rate can become 22%. But there are certain conditions to this. So as per the income tax, a company will be allowed to claim various expenses like your depreciation, additional depreciation, Chapter 6A deduction, and various income-based deductions. But however, if you want to claim all those deductions, tax rate at the rate of 25% will be levied. But if you are an organization wherein all these declare various deductions, there are around 15 deductions which are applicable, which has been restricted. Only those deductions will not be allowed if you opt for taxation under section 115BAA. And this is applicable to only the new companies who have registered. Now, just to give you a brief, let's say as per the Companies Act, the income tax, there are around 50 laws, 50 general category of expenses which a company can take. But if you avail section 115BAA, then only around, let's say, 40 expenses will be allowed. The other expenses will not be allowed here. Considering which, based upon the facts and circumstances, you should arrive at a decision whether which model is the best suitable for your company. Now, one of the other section which was introduced was section 115BAB. So in case of 115BAB, this is applicable only for the case of manufacturing companies. The rate which has been specified is not 22%, but it is 15% though. I think there was a slight clarification mistake here. So in case of 115BAB, likewise to taxation discussed as per section 115BAA, this section is applicable only for those entities which are in the process of manufacturing, or they are doing certain research activities for the purpose of manufacturing. And if they fulfill all these necessary criteria, then tax at the rate of 15% is levied. I repeat, in case of generally, it is 25%, and if you want to opt for special taxation under section 115BAA, there are certain deductions will not be allowed, and for that purpose, the tax rate will be 22%. And similarly, coming to if you are a manufacturing entity, then the tax rate will be around 15%. Now, talking about income tax, generally the government would state that you pay the tax at the year end once the financial statements have been prepared. And just to give you a brief, the financial year is from 1st of April to 31st of March every year. And assuming that the financial year has ended, the government would then require you to file your income tax return, post which you will be required to pay your taxes. But however, the government will have to wait for a substantial period of time to collect the taxes. And for this reason, they have introduced a concept called as advance tax. So what happens is that the company, rather than paying at the year end, they'll be required to pay the tax, which is, let's say you have considered around 25% of your profit. The company will be required to pay part of that tax in quarters. So for the first quarter, the due date is 15th of June, and subsequently on 15th of September, 15th of December, and for the last quarter, it is of 31st of March. So initially you might ask, how do I know? How do I pay for this? So the government has stated that only 15% of the total tax liability. Let's talk in terms of numbers a little bit. Let's say the profit of the company is around 1 lakh. So the tax rate, assuming it as 25%, it comes up to around 25,000. Correct? Now, the company is the law states that in the first quarter assuming that the profit is for the first quarter, which is April, May and June, the company earned a profit of 1 lakh and the tax rate is around 25%. Now post this, the statute states that you will have to estimate the profit for the remaining year. That is for the quarter 2, 3 and 4. You will be required to estimate as to what would be the profit. Let's say you assume the profit to be equal, which is 1 lakh, 1 lakh and 1 lakh. So throughout the year, the actual profit is for the first quarter is 1 lakh and you estimate the same trend to follow in the subsequent quarters as well. And for that purpose, the total profit of the company is now 24 lakhs and the tax which would be applicable is 25%. So it would be around 1 lakh as total tax. So 1 lakh of the total tax is what you might have to pay at the end of the year. But however, the government now states you pay only 15% of it. The 15% of 1 lakh, the total tax liability. So initially, in the first quarter, only 15,000 has to be paid. Now let's say the first quarter passed by, we are at the second quarter, coming to 30th of September. So the due date for the second installment is 15th of September. Now that we know that what is the actual figures of the first quarter, which was 1 lakh profit, assuming that we earned 2 lakhs in the second quarter. So the actual profit earned till date is 1 lakh for the first quarter and 2 lakhs for the second quarter, which gives up to a total tally of 3 lakhs. Now, the government again tells us, you estimate it for the remaining 2 other quarters, which was for the quarter 3 and quarter 4. Assuming that, let's say for each of the quarter, now the company estimates the total profit for each quarter to be 1.5 lakh and 1.5 lakh. So right now, the actual profit was 1 lakh for the first quarter, 2 lakhs for the second quarter, and then the estimate amount is 1.5 lakh and 1.5 lakh for the remaining 2 other quarters, which gives up to a total profit of around 6 lakhs. So on 6 lakh, 25% will again be levied. So assuming that on 6 lakh, 25% is around 2 lakhs or 2.2 lakhs. So that would be the total tax which should be paid. But however, you have paid around 15% of it, which came up to 1 lakh. Now the government tells that 2.2 lakh was the total amount. You don't have to pay the entire amount, but just pay me the 45% of it. 45% of 2.2 lakh, which let's say around comes up to 1.1 lakh. So initially in the first quarter, 1 lakh had been paid and then the remaining amount is only 10,000 rupees. So in the second quarter, only 10,000 has to be paid. So likewise, a similar thing will be done for the third quarter as well as fourth quarter. And then subsequently, the company will have to file its income tax returns. So at the year end, generally in case of companies, the due date for filing of income tax returns is 30th of September. And let's say the company had already paid, assuming around 3 lakhs of advance tax in advance. But at the year end, when the company actually computed their profits, assuming that the total tax amount came up to 5 lakhs. So now the government will state, you have paid the tax amount in shortfall. Initially when we paid the advance tax, you have paid only assuming as 3 lakhs. But at the year end, when we got to know, after considering all the facts and figures, the tax amount which had to be paid was 5 lakhs. So nothing to worry. The government will now tell us, since you've already paid certain amount of 3 lakhs, kindly pay the 2 lakh rupees now. So at the time of filing of income tax return, the company will now be required to pay the differential amount of tax, which is amounting to 2 lakhs. Now there might be a possibility wherein we have paid tax in advance, but however, subsequently, let's say there was a huge loss in the company, a catastrophic event occurred, and there was subsequent huge amount of losses. So in that case, assuming that the company had paid tax in advance amounting to rupees 3 lakhs, but subsequently the profits of the company dropped drastically. It came down to 1 lakh rupees only. So the company has paid tax of 3 lakhs, but the actual what they were liable to pay is only 1 lakh rupees. So now the company can state to the government that my actual profit is only 1 lakh rupees and the tax liability is only 1 lakh, and I have paid you 3 lakh rupees, kindly refund the 2 lakh amount which I have paid in excess to you. The government will refund it. Yes, you heard it right. The government will refund you any amount which you have paid in excess. Now, there are also other main categories which is called as tax deducted at source. Quite often, the government states that. I'll explain this concept with the help of an example. Let's say Reliance. So, each and every employee, let's say they are getting paid of rupees 10 lakhs per year, and they would be receiving around 90 to 80,000 per year. So every time at the year end, similarly, advance tax is applicable even for every individual. So right now, the government states that to Reliance, since the income is being generated in the form of salary, who is paying? Reliance is paying as an employer to the employee. So the government states, rather than collecting it from, let's say Reliance has 10 lakh employees and Reliance is a single person who is paying the income to them, the government states, anyways, all the employees will have to pay tax at the year end. So the government would not want to go to 10 lakh employees and then collect the income tax. The government would state to Reliance, since you are making this payment to income tax to the employees, I would want to collect the tax from you only, because the income is being generated through the employer. So every time the employer is paying some amount of income to the employees in the form of salaries, a part of their salary is deducted in the form of TDS, which is nothing but your income tax. So for this purpose, as soon as the income is deducted, so this is purely for the purpose of salary. There are various other situations which have been provided for the ease of the government in order to collect the tax from the residents. Around 20 to 25 such transactions, specified transactions, have been provided. One of them is salaries. The second one is with respect to, let's say, there are any contracts. If you have certain interest, again it will be applicable. If you're making any payment to non-resident, or if you've considered any rent, any furnitures, fixtures, or any building on rent, again TDS will be applicable. The rates of TDS depends upon the kind of transaction which is there, and it depends on the categories which have been provided. Generally, the due date of making the payment of TDS, which is tax deducted at source, is 7th of every month, and the return filing of the TDS has to be done on a quarterly basis. Every month. And let's say, what is the proof of it? Generally, the employer has deducted certain amount, and how does the company, or let's say talking in terms of the salary, wherein the employer had deducted certain tax at the time of making the payment. So what is the proof that the employer will have? What if the employer subsequently states that does not deposit the tax amount to the government? So for this purpose, the government has made it mandatory that whoever is deducting the tax, such person should provide a certificate called as the TDS deduction certificate, and this, whatever amount has been deducted, will then be reflected in the Traces portal, which is a government portal wherein all your tax deducted at source will be reflected. This again can be utilized for the purpose of paying income tax. Coming to income tax filing. Generally, in case of income tax, The due date of filing of return is 30th of September, but majority of the times the due dates are extended. It first gets extended to 1 month, 2 month, 30th of December, 31st of December, and in the recent year, which was for the financial year ended 31st March 2021, the last due date was 31st March 2022. So the due dates keep getting extended, but however, please ensure that generally the due date of filing of return as specified by the law is 30th of September every year. One of the main things, again, in case of cross-border transactions is with respect to transfer pricing. So what exactly is transfer pricing? The government now states that if you are involving in cross-border transactions, let's say Reliance, they have a company in India, and if they have a company, let's say in Malaysia, so the tax rates in Malaysia is quite different, and for that purpose, the company in India can enter into transactions with the company in Malaysia for the purpose of tax saving. So for that purpose, the government states, if you are transacting with any related companies outside India, so then the provisions of transfer pricing rules will apply. So the transfer pricing rule states that is the transaction rate. Let's say Reliance wants to sell some oil to its company which is situated in Singapore. So here, the Indian company cannot state that I will sell it at a very low rate, because in India the tax rate is around 25%, but in case of Singapore, assuming that it is very 10%. So they might show it as a very less rate in order to reduce the profits here, and then subsequently generate income in its Singapore entity. For this purpose, in order to avoid all these cross-border transactions and evading of taxes, the government has stated that any transaction which is being done should be based on the arm's length basis. What I mean by arm's length basis? Assuming that Reliance wanted to sell certain oil to any company in India, what would be the rate? Assuming that it is $18 per barrel of oil, similarly, the transaction which would be applicable, the rate which would be applicable for the purpose of international transaction should be around more or less equivalent to $18 per barrel. Depending upon other circumstances, the rate should be on arm's length basis, which is basically meaning of that is on a market basis. It cannot be exorbitantly high prices or a very low prices. It has to be more or less equivalent to the market rate. Talking about GST, assuming that your company was incorporated recently and you have obtained the registration for under GST. GST is not mandatory for all the companies. Just to clear it, there are only certain companies who would require to have GST. But yes, again, it becomes voluntary for few companies if they just want to go ahead and obtain GST for various reasons for their own benefit. Yes, they can do it. Just to give you a brief, when GST registration is mandatory, if let's say the turnover of the company crosses 20 lakhs, then GST becomes mandatory. But apart from turnover, assuming that there's cross-border transactions, which is, let's say, from the state of Delhi to the state of Maharashtra, if there's any sale which is happening there, then the company, irrespective of the turnover, is mandatory to have GST registration. On the other side, let's say we are currently in the digital economy right now, and you might want to sell through Amazon, Flipkart, and other various e-commerce platforms. For that purpose, if you are selling through any of these e-commerce operators like Amazon, Flipkart, and others, then irrespective of your turnover, profit, or paid up capital, it is mandatory to opt for GST registration. And yes, if you are not falling under any of these mandatory criteria, you can still go ahead and register voluntarily in order to avail the GST benefits. Now let's say you have obtained the GST registration. Please ensure that you link your bank account to the GST portal within a period of 45 days from the obtaining GST certificate, failing which the GST registration will be cancelled. Quite often, you might ask, at what rate should I charge my GST? If you're selling certain goods, should I charge 18%, 9%, 28%? At which rate do I charge the GST? And the government has specified certain codes, which is called as HSN code. So these codes are based upon certain goods as well as the services. Based upon the goods or services that you are selling, HSN code would be considered, and each code has certain rate which is being provided by the GST. If let's say you are selling a restaurant business, and if you have an air-conditioned restaurant, then the GST will be considered at around 28%. And why am I stating as 28%? This is purely on the basis of the HSN code which is being provided in case of a restaurant which is carrying on its operation, an air-conditioned restaurant. On the contrary side, let's say you are purely into trading of apparels, and depending upon the type of apparel as well. If it is a woolen cloth, then it would be around 5%, because the HSN code for in case of sale of apparels of a specific material is 5%. If it is a leather, then again it might depend upon it. So please ensure that the HSN code which you have been provided, you select the appropriate HSN code in the GST portal. Once you've selected the HSN code, you've linked your bank account, post which it becomes necessary that you file your returns. Now, the government has stated that there are two options. The first one, either you can file it on a monthly basis or on a quarterly basis. When I'm talking about the filing, what exactly goes into this filing? There are a few basic returns which are applicable. The first one is your GSTR1. So every month, the company is required to file GST returns, and this GST return, GSTR1, contains few basic details like your sales and the credit notes which have been there. Every month that has to be provided, which generally is in the range of 10th of every month to around 13th depending on different states, but let's keep it as a fixed date as 10th of every month. And subsequently, the GSTR3B, which contains various details like your purchases, sales, credit notes, debit notes, all other details will be included in GSTR3B. And the payment of the tax liability will be required to be paid on the 20th once the GSTR filing is done. Now, quarterly and monthly. Initially, I had stated that every month it has to be filed. But however, there's an option for various entities wherein if they have turnover up to 5 crores, then they can file the GST returns on quarterly basis. You may ask, okay, that really makes a lot of sense and would save a lot of your time as well. Rather than maintaining various transactions, it would save a lot of your time. Here, I would also want to know that in case of filings, only if it is up to 5 crore, it can be quarterly. But however, if other than those details, it is mandatory to file it monthly. Again, there is an annual report which has to be filed on 31st of December and which contains various reconciliation. At the end of the year, if your revenue crosses around 2 crores, GST audit will be levied, and this audit will be done by a chartered accountant. Last but not the least, few basic details with respect to labor law. As soon as your company is registered, you might start receiving various emails from various companies as well as various labor departments, government departments. And one such email would be an email from ESIC, which is called as Employee State Insurance Scheme. So you might receive an email from this email ID. Please note, this would provide you certain credentials for the purpose of your ESIC and Provident Fund. So through this login credentials, you would be able to file all the labor related compliances. And few of the basic compliances which would be applicable is your professional tax, and this is mandatory for all the employees irrespective of their turnover or irrespective of the salary which they are earning of the employees and irrespective of the number of employees. Professional tax is mandatory, but generally in case of professional tax, if the employee is earning around, let's say, 15,000 or less, professional tax is not to be deducted. Each state have their own threshold limit, salary threshold limit, and it would depend on each state, but generally it would be around 15,000 rupees salary. In case of ESIC, ESIC is just a employee state insurance scheme for the welfare of the various employees. This is applicable only when the organizations having 10 or more than 10 employees, and for this purpose a small contribution has to be made by the employer. Provident Fund. Provident Fund is again a welfare scheme which is being provided by the various governments, and it is mandatory for all the organizations when they have employees of 20 or more. Gratuity. With respect to gratuity, an organization is liable to pay gratuity only and only if an employee has stayed for a period of more than 5 years. If the employee does not stay for a period of 5 years, gratuity is not applicable. Bonus. Bonus is applicable only in case of workers and laborers, and it is mandatory to provide bonus at the rate of 8.33% of their annual salary. And a few couple of details which I would like to let you know here. As soon as your company is incorporated, you might receive certain couriers from various people and unsolicited emails and all of the details. Kindly do not accept any courier which might tantamount to be from the government agencies. Kindly do not accept those. If you have a slightest suspicion that you are being cheated or anyone is asking you any money for the purpose of any documents, kindly do not provide. The government does not ask any money for the purpose of any documents or registers which is to be done. So please do not accept such couriers, and we have reached to an end of the conversation. If you have any other questions, you can always reach out to our team, and if there are any questions, I will quickly take few questions here. So if you have any questions, you can put it down in the comment section and I'll be more than happy to answer those. So I believe there are no questions here, but feel free to reach out to our team for any of these compliances, or if you have any queries, do not hesitate. Our team would be more than happy to connect with you and provide you the right information which is applicable. Stay safe and have a good day. Bye-bye.